All right, good morning. Today is September 25th, 2024, and I am back with another edition of the Wednesday live show. And if I sound kind of strange, it's because I have a cold. So I can tell that I don't sound my normal self. But fortunately, it's a very mild cold, and I'm getting over it. But you know how those things are. Typically, I haven't actually had a cold in many, many years, but I used to typically get one around the time of the seasons change, and so the seasons definitely changed here. Feels like fall, and you may have noticed if you're watching from the website that I'm working on a brand new website for investingsystems.com, and it's still under construction, but I've made a little bit of progress with it in the past couple of days, and so lots of exciting new things coming. I'm actually considering adding some stock picks and swing trade setups right to the homepage of investingsystems.com. And so you can watch the show just by going to investingsystems.com and clicking the scroll down a little bit, click the show link. So yeah, that site is a work in progress, but it's going to be really cool as we go. There's going to be a lot of neat stuff added to it, and so it is what it is. Um, Lots to talk about today, although my goal going forward is to keep these shows at about 30 minutes because I know that I know that the shorter the videos the better. Quite honestly, when I go to YouTube and I see something interesting, a lot of the decision on whether I want to watch it is based on the length of it because, like so many other people, my attention span has diminished over the years, and I can no longer sit still and watch a really super long video. So these 30-minute once a week shows I think are ideal, at least for now. And let's jump right into things because I'm going to start off with my new sort of format here is to start off with a few interesting sort of graphs and charts that I find around the internet. And as we all know, last week was Fed Day, and when I was doing the show, we were debating whether they were going to cut 25 or 50 basis points, and of course they cut 50 basis points, and that's about what the market expected, which leads everyone to wonder whether the economy is not as great as they say it is. I mean, Powell, said the economy is doing good and that. So I was thinking about this earlier today. Their dual mandate, stable prices and maximum employment, well, they sort of blew the first part of that. And of course, they put the blame on everything except for the fact that is that they created trillions of dollars out of thin air that watered down the money supply, and that's why everything is so expensive nowadays. And it's as simple as that. I mean, for all of the analysis and talk and Fed speak and all this and that, I mean, anybody that took basic economics knows that all throughout history, as the money supply increases, then that results in inflation. And so they blew that part because and funny thing is they even admitted it. I mean, it didn't make the national news headlines obviously, but the Fed admitted that they overreacted during the pandemic, and that basically resulted in inflation. So, but that's water under the bridge. So anyway, the big question is now, are they behind the curve? Is the economy slowing? The reason they cut 50 basis points is, maybe they were behind the curve. Maybe they should have started cutting earlier. So, anyway, all that aside, we looked at the Buffett indicator last week. And you'll have to excuse me if I cough a couple of times because, as I mentioned, I do have a cold. So, we looked at the Buffett indicator last week, which is basically market cap to GDP, and we saw that it's at an all-time high, right? So, according to that, um, the market could potentially be overvalued, from a longer term perspective. And of course, it's no mystery that Mr. Buffett has cut back a lot on his major investments, notably Apple and Bank of America. But this I found, and this is, I believe it's Bespoke puts this out. And what this is basically showing us is that in the very short term, most of the market is either overbought or extremely overbought. And so these are the 11 spider sectors, right? And this is what they do is they measure the standard deviation from the 50-day moving average. Pretty simple and easy to understand, and I actually like this. This is fantastic. So this is one standard deviation from the 50-day moving average. This is two, and then the right side of this red column would be 3. And so what we see is that, these sectors here are extremely overbought based on the fact that, they're over 2 standard deviations above the 50-day moving average. So, and of course, as we know, overbought can stay overbought for longer than, that doesn't necessarily mean it's a pullback is imminent, but it's sort of a caution flag, as I like to say. Red flag or a yellow flag, you decide. But a lot of the market is overbought. Interestingly enough, technology is not overbought, right? And I was looking through some charts this morning, and quite frankly, the semiconductors are pretty darn interesting looking right now. So we'll take a look at a few of those in a minute. And of course, we know that the price of energy and oil is mysteriously low, right? Gas prices are low. Of course, it may or may not be so mysterious based on the idea that of the upcoming election. What we need low energy prices. But anyway, I saw a chart this week that the United States is producing more oil than Saudi Arabia, which was interesting. So another interesting chart here. Let me zoom in a little bit here. We looked at a similar chart last week, and lots of people put out different charts as far as what typically happens after the first rate cut in a rate cut cycle. And I had a couple charts on this last week, but this one, I like the way that this is presented. This is the best presentation I think I've seen of the whole thing yet, because basically it shows a chart of what the market looked like for the year following the first rate cut, right? And so, and of course, here we go. This is, it shows, and it goes all the way back to 1984 too. So the funny thing about these kind of statistics and historical analysis is that these statistics can easily be manipulated to sort of reinforce one's belief, right? And so, I saw quite a few posts that had, just these last 3 rate cuts, right? And they would lead you to believe that when the Fed starts cutting rates, that, that means that there's a good chance that the market's going to tank. Now, this one was sort of an outlier, obviously, but what's interesting about the July 2019 rate cut is I recall that there was a lot of weird sort of turmoil in the markets as far as like the back end plumbing goes prior to the whole COVID thing, right? So this obviously was the COVID 35% bear market, I guess you'd call it. This transpired pretty quickly. I mean, I don't want to call it a crash, but it was pretty close. But anyway, interestingly enough, the Fed started cutting rates in the summer of 2019. And I remember a whole lot of discussion on like they were creating money out of thin air to give to the banks, and all kinds of sort of crazy stuff was going on. I mean, they were doing like QE in that in the summer of 2019, so it was a little suspicious and unusual. But anyway, long story short, here's the S&P 1-year performance following the first in the series of rate cuts by the Fed. And so this is just a great graph that basically shows, more times than not, I mean, at least during these cycles, prior to 2008 I'm sorry, the 2000, this would have been the dot-com bubble, and this would have been the great financial crisis, right? So they're kind of, the way they've staggered these, you have to look at it carefully. But anyway, so it is what it is, and you can see, so this is 1 year later, 10%, 14%. So there was only actually 2 instances here. Actually, you could probably, like I said, this is the outlier because, the COVID crash and recovery. And so this is sort of an anomaly. Anyway, I thought that was pretty interesting. Last graph here is, and this is kind of interesting too. So the U.S. market cap is almost half of the global market cap, even though we're only like, I think I saw it said 25% of global GDP. So the U.S. is, and don't quote me on this, roughly 25% of global GDP, but our stock market is half of the market cap. So I'll let you decide what to take away from that. All right, so looking at the charts here, this, excuse me. Oh boy. Yeah, this is the unfortunate result of doing a live show. Well, I have well, I'm getting over a cold. Is that I still I have that cough and I feel like I need to blow my nose, but I'll power through this and keep it quick. We're almost halfway through, so I mean I wanted to look at quite a few charts today, but anyway, this particular unusual candle right here is a week ago today, and that's when the Fed cut interest rates. Initially, the market rallied, broke out to a new high, and then they jammed it down and closed at the low of the day. And so, I mean, normally, if I, normally, based on every technical analysis book on my bookshelf, that would have been sort of a reversal day, right? But then, of course, the market likes to fool as many people as possible, as they say. And so the very next day, we got a huge gap up to new all-time highs. So that's quite unusual. And so that's why, you gotta kind of, I've joked around for years, you in the market, you almost have to do the opposite of what makes sense. And so this is just sort of, it's bizarre, put it that way. And obviously, most candlestick patterns need confirmation, and so you wouldn't have necessarily, said, okay, well, I'm going all in short after you saw this. You'd want to wait to see, a little confirmation, especially the net, you want to see the reaction. Typically, it takes the rest of the week after a Fed announcement, and or especially the first rate cut in a cycle. So anyway, long story short, you can see what's happened since then. But boy, that was probably the opposite of what most people expected. So as they say, expect the unexpected. And since then, we've had like a series of just kind of narrow range days to all-time highs. Now this zone right here, and I don't know why it says this chart is not saved, but I need to save this because it looks identical to maybe I moved something on here since I saved it last, but what I did was I had this zone, which is obviously, it was resistance and now it's support. I extended that to the right. That's probably why it was asking me to save again. So there you go. The market is, when you talk about support and resistance, the funny thing about looking at this chart is there's no resistance, right? That's why they call it blue sky. There's literally no overhead resistance and there's tons of support. And so it's going to be interesting to see how this plays out. There's the 50-day moving average. There's another support zone. There's a big sort of resistance support, all that good stuff. So um, another thing that's kind of interesting before I move on is that going into September, everybody was sort of cautioning that September's typically the seasonally the worst month of the year, historically speaking, which it is. Most people think of October because that's when a couple of the major crashes occurred. But September historically and seasonally speaking is the worst month of the year, and especially the back half of September. And here we are, right? Here we are. It seems unusual to me that I mean, the market had been sort of pricing in the Fed pivot and rate cut for, about 2 years now. And so this, I've seen some people say that this is the last gasp. And, and of course, obviously, everything that I say is just pure opinion. But this does not seem like a place, this doesn't seem like a good time to chase the overall market, right? However, let me just fast forward to the semiconductors, and then maybe I'll circle back if I have time. So this is the semiconductor ETF, the SOX, SOXX, and I got to tell you, this is a pretty darn constructive pattern. And there's a few individual semiconductors that have similar patterns that look pretty darn good. And so what I wanted to emphasize here on just the overall sector is sort of this W pattern that's forming, right? And so you've got there's an area of resistance right up here, and you can see that that's a 200-day moving average, that's the 50-day moving average. So you got this sell off, poked below the 200-day, right back up, ran into resistance at the 50-day. You got a higher low here, and so this is quite frankly is a pretty constructive looking pattern, no matter how you slice it. You draw a little triangle on there. So, one of two things happens is it runs into resistance right around where it is now, which is, a distinct sort of possibility. Well, you can see that it's up 1% as we speak today. And so it's kind of running into a little bit of resistance here, and so there could be another trip back down, right? The MACD is looking pretty constructive, and there's overhead resistance right there. So everything about this is kind of looking like, and here's the thing, and you've heard me say this probably for at least the past couple of years, is that these W patterns are some of the strongest patterns, and I can remember this going back to like 2015, 2016. Whenever you see a W pattern and you get a rally above the, I don't know if there's a term for the middle of a W, but when you get a rally over that, typically it carries. And so even though a lot of times it can look extended, let me give you an example. Let's see, where is, I guess maybe if I sort this. Yeah, there we go. If I sort this right now, luckily, Luckily, the semiconductors are having pretty good days. Look at this. This is not really so much of the normal W pattern, but look at this. This is pretty amazing. Um, I'm not going to draw it on here, but keep an eye on ARM over 150. This is actually a pretty, this could potentially be setting up for a really nice low risk, high reward trade because there's a clear, if it can break out basically above 150, um, super tight stop. You could use a really super tight stop just under these lows there. Um, and so, I mean, that's got a good looking pattern to it. But so, a lot of these semiconductors, NVIDIA's got kind of, something similar going on that I was talking about. I mean, there's the big W pattern, right? And it's also got the old triangle going on here, and so I mean that's kind of a beauty. And it had a run from the bottom of this upward sloping trend line, and then a nice consolidation here for a couple of weeks, and now it's starting to bust out again. And obviously, with these kind of patterns, you have to watch how it reacts when it gets to the downward sloping trend line. But this is a pretty darn constructive pattern, if you ask me. And so, um, if these semiconductors reach sort of the top of their patterns and then come in a bit, that might even set them up better. To be honest with you. Look at AMD here. I've already sort of marked this one up. AMD is kind of what I was talking about earlier as far as the W pattern. This is about as good as it gets, right? And look at it. It's starting to push through. If I change this to a candlestick, basically it would sort of be breaking out of this pattern as we speak here. And so this is extremely constructive. I mean, there's a couple of caveats here. One is that sort of downward sloping trend line there, right? And so if it does manage to push out of here, chances are it may run into some resistance. And also, at this point right here, it's running into a little bit of resistance. And so the fact that, that first graph that we looked at where everything's overbought except for technology, right? Because these things have had significant pullbacks already. Makes it kind of interesting. So I wanted to look at Microsoft too real quick while we're here. Because, I think we talked about Microsoft last week, and it's actually kind of an interesting example of what I've just been talking about here, right? So Microsoft had that same almost identical W pattern that we just have been talking about on these semiconductors, and you can see that once it pushed above the middle of the W, got a little traction. It came up here into another resistance area, and as we speak right now, it's coming back and testing this area sort of as support, right? So this will be an interesting one to keep an eye on. Basically it's in a range right now, and so it's not really, there's nothing, in my opinion, there's nothing really too actionable going on here at the moment. But other than, perhaps, obviously yesterday, whenever you see an inside day like this, I might as well save these markups I put on the chart. So sometimes it's fun to come on the show and just mark this stuff up, live or whatever. But I used to say a long time ago on this show that basically I could look at any chart and I mean just about any chart and find a place where you could actually, buy the stock and put a stop, right? And so it's just a matter of, and some are easier than others, but just for the fun of it, yesterday's high I mean, for a really, for a really short term sort of, well, I'm struggling now. Well, basically, what I'm trying to point out here, and I'll just save that. Basically, you could buy Microsoft over yesterday's high and put a stop, under yesterday's low, right? Because it's had this nice pullback. It's pulled back to support. You got an inside day. Doesn't mean that I would necessarily just pull the trigger on this. And so that's something we'll talk about, in the future. You guys have been watching the show for a long time and following us for, a decade. Know that, we're big believers in triggers, right? And so whenever we look at the idea of taking a trade, there's always a trade barrier slash trigger price, entry price, that type of thing. And so, when I look at this chart, I wouldn't just jump in this. So the trigger would be over yesterday's high. The stop could go right below yesterday's low. And so I mean, so something like this, that'd probably be more something that you'd look to trade with like an option. But basically, the reason I bring this up is because it makes a point of that W sort of pattern that I really like. And over the years, I've noticed that when stocks form a W pattern, I mean, if you squint at it, and ignore this part, and what's constructive about this, and some of those semiconductors, is that the right side of the low part of the W pattern is a little bit higher than the left side, obviously, which means you can draw an upward sloping trend line on it too. And so just something to consider. But basically, the trigger on the W patterns is when you break out past the resistance at the middle of it. So real quick, let's look at the Qs here. As we talked about last week, oh, look at this. Oh, geez. Look at this. Imagine that the Qs have this W pattern right here, right now that we've been talking about, and just starting to poke out of. Look at that gap. Look at that. I mean, just absolutely amazing. There we go. How about that? Oh, I got to save that so we can come back and look at it. Oh, geez. So how about that? It's right up against, I mean, literally right up against sort of the other top. Now it's actually this week it's cleared the middle of this W pattern, and there's a gap right there. So it's going to be extremely interesting to see how this manifests. And the thing of it is, if it were to come in just a little bit, even 475, I mean, there's no rule that says that it has to just keep going straight up, right? So a little bit of consolidation really would not invalidate this, breakout from this. Well, it hasn't broken out yet, but a little bit of consolidation would not invalidate this pattern. So anyway, very, very interesting. The semiconductors are, excuse me, semiconductors are looking pretty good. The Qs are looking pretty good. The Fed is cutting rates. The economy, the only sort of negative, well, there's a lot of negative stuff out there. I mean, half the market is extended. The Buffett indicator showing it's the most overvalued in history. Unemployment is rising. Inflation, when we haven't even talked about that. Has inflation come down to, has the inflation rate come down to 2, the core inflation rate come down to 2% and stayed there for a very long time, like Powell said, before they were going to start cutting rates? Well, that's debatable, right? And so the worst thing that can happen now is that, they cut 50 basis points and and then inflation starts picking back up. And then of course you got to throw the election into the whole mix here. So there's a lot to consider when it comes to a macro perspective. But I got to say, from purely objectively, which is how I like to, it's fun to talk about macro and economics and all that stuff. But quite frankly, approaching the markets from a purely objective standpoint, looking at the charts, um, is the way that I've always thought best course of action, I should say. So, all right, before I cough again, I'm going to go ahead and wrap this up. Thanks for tuning in. If you're visiting from investingsystems.com website, I just want you to know that website is basically still under considerable construction. So between now and the end of the year, there's going to be a lot of new stuff coming that I'm working on, and then I'm already looking forward to 2025. Making a lot of improvements, enhancements, and changes around here. Taking that website up a notch. We're going to get back into some swing trades and stock picks and all that good stuff, trade setups. And so, hey, thanks for tuning in. I will see you back here, same time, same place next week.